There is a number in your investment you will never see. Nobody will send you a bill for it. You will not see it on a bank statement, but over 30 years, it can eat a quarter of whatever you have built. Not a crash, not a bad decision, a fee. It looks like a rounding error, less than 1% a year. But this is not a rounding error. And today I will show you why. And I will show you a second thing that can destroy your plan. And this one you can feel much more than the first one. Hi, I'm Marco and welcome to Reaching 10. On this channel we talk about early retirement in Europe without hype, focusing on what actually works. Quick recap, a stock is a piece of a real business and instead of picking winners, you own the entire street. Maybe via an efficient product like an ETF. Boring, correct, accessible. Today, we will see how much this strategy can cost you. So let's take a look at the cost that nobody feels, but is the one that does most damage. Here, the result first, and then I will explain you why. Let's take two people, same amount of money, same market, same period invested. There is only one difference. The first one pays 0.1% in fees. The second one pays 1% in fees. 0.9% different looks like nothing. Well, it's not. Over 30 years, that gap is roughly a quarter of the entire wealth for something that looked like a rounding error initially. Now the mechanism. Every ETF charges a small cost. This cost is seen as annual fees, or in Europe is known as TER. These annual fees are invisible because they are taken yearly from your returns. So your returns will simply be a little bit smaller every year because of this fee. Some ETFs will charge 0.3%, some will charge 1%. The actively managed fund will maybe charge 2% or more. It sounds tiny, but as we've seen, it is not. But how come a rounding error becomes a quarter of your wealth? This is because fees do compound like your returns. So a fee of 1% on a smaller pile is different than a fee of 1% on a bigger pile. 1% on 100,000 euros is very different than 1% on 1,000,000 euros. The second reason why fees are against you as an investor is that every year you miss the returns of the past fees, meaning that if the return is 7%, for instance, then you get every year only 6%. And this is why the fees are so important when you choose what you are investing on. Basically, this is like compound interest in reverse, running against you for decades. And this is why when you compare two ETFs or two products, the fees are so important because this is what makes a difference between a good outcome and a great one. I'm not telling you which ETF to buy. This is not what this channel does. I'm telling you that when you evaluate different products, the fees are not a footnote, they are the headline. If this resonates, please subscribe. It's a big help for the channel. That was an invisible cost. But let's go now to a cost that you can feel and will feel. The market drops. When you take a look at historical patterns of US data, you will see that roughly the market drops around 10% every 2 years. It will drop around 25% every 5 to 7 years, and it can drop 40 to 50% in some years. 2008 happened, 2000 happened, 1973 it happened. So the market drops, sometimes a little, sometimes a lot. And this is not a bug, this is the price of admission. You accept to have a bumpy ride to have bigger returns. You are basically paid to stand volatility, This is why you are an investor at first. Here is what this means in practice. If you put money in the stock market and you had a bad year, the only thing you can do is that you will see the money slowly dropping. Maybe 30% day by day over a year. And then you get so frustrated that you will sell in the worst possible moment. Almost everyone that sells at the bottom does so because they have not realistically pictured what the bottom feels like. The framing that helps me is that the price is just the price. If the price changes, Coca-Cola will still make Cokes, the bakery will still make the bread, so you will still own the same real businesses. Well, maybe they will sell a little bit less, but what has changed dramatically is the price, not necessarily the business. If you own the street and you do not need the money for some time, that is just an information. You do not need necessarily to act on that information. That is cost number 2. It's real, it's emotional, and it's manageable. If you go in with your eyes open. So let's close this out. 3 videos on stock. Let's make a summary in 4 sentences. A stock is a piece of a real business. You can't reliably pick which business will win, so you own the street. The ride is bumpy. That is the cost of long-term returns. And fees are the silent killer. So cheap means more than clever. That's it. That's stocks. Now you know more of 90% of people owning them. But there is one piece of information I left out for today. What if you need the money tomorrow? What if you can't wait and ride it out of a bad market? What if you are 62, you are approaching your pension, and you see your portfolio halved? Can you stand it? Maybe you can't, and maybe you shouldn't, because there are other instruments that are made to solve that problem. They are different in nature, they have a smoother ride, and they are lower in returns, but they also are a possibility to have something to sell when stocks are down. Those instruments are called bond, and that is the core of our next video. I'm Marco. Let's engineer your freedom. See you in the next video.